Most people think nothing is happening in the silver market right now. Prices look quiet, headlines feel empty, and attention has moved somewhere else. But history shows something very different. Whenever silver goes quiet for too long, it's usually because pressure is building where most people aren't looking. And right now, new data is starting to confirm that physical silver supply is tightening again. Not suddenly, not dramatically, but quietly. And in markets like silver, quiet tightening has always mattered more than loud panic. Before we go deeper, if you appreciate calm, data-driven updates without hype or fear, make sure you like this video and subscribe to the channel. It helps the monetary shift reach more people who care about understanding real monetary changes instead of reacting late to headlines. Now let's talk about what's actually changing. Because this update isn't about opinions, it's about numbers, behavior, and physical movement of metal. Silver is not just a price on a screen. It's a material that has to be mined, refined, transported, stored, and delivered. And every step of that chain leaves data behind. When you look at that data together, a clear picture starts to form. First, global silver production. Over the past year, mining output has remained tight. There has been no meaningful surge in new supply. That's important because silver supply doesn't respond quickly to demand. Most silver is produced as a byproduct of other metals, which means miners don't just turn on silver production when prices rise. If copper or zinc production slows, silver supply can tighten even if silver demand stays the same. Recent reports show that production growth remains limited and that structural constraint hasn't changed. Next is industrial demand, which continues to surprise people. Silver demand from electronics, medical equipment, and especially solar energy has not slowed the way many expected. Solar panels alone consume a massive amount of silver, and those projects are long-term. Once they're planned, they don't get canceled easily. This kind of demand doesn't care about short-term price swings. It simply absorbs metal year after year. Now let's look at physical investment demand. Retail buying hasn't exploded, but it hasn't disappeared either. What's interesting is that inventories are not rebuilding the way they normally do during calm periods. Usually, when demand cools, stockpiles grow. Right now, that's not happening consistently. Physical silver continues to move out of certain systems faster than it's being replaced. That's a subtle but important signal. Vault inventory data supports this trend. Silver holdings in major storage systems have stopped growing and, in some cases, started declining again. This does not mean vaults are empty. That's not the point. The point is direction. Rising inventories suggest excess supply. Flat or falling inventories suggest tightening conditions. And silver is clearly no longer in an expansion phase. Delivery behavior adds another layer. Physical delivery requests tied to futures markets remain historically elevated. This tells us that participants are still choosing metal over paper exposure. That choice usually reflects long-term thinking. When people worry less about price and more about access, deliveries tend to increase. That's exactly what the data shows. Recycling is another area worth watching. Silver recycling is highly price sensitive. When prices spike, recycling increases. When prices stay calm, recycling slows. Current data suggests recycling volumes are not surging. That means the market isn't getting extra supply from scrap flows. Without that cushion, the overall supply balance stays tight, even when demand is steady rather than explosive. Geographic movement also matters. Physical silver continues flowing into industrial regions, especially in Asia. Once silver enters manufacturing supply chains, it effectively leaves the investment market for years. It doesn't come back quickly. That slow drain matters over time, especially when new supply is limited. When you put all of this together, the picture becomes clear. The silver market isn't loose, it isn't oversupplied, and it isn't in crisis either. It's in a narrow balance where even small changes can have large effects. Historically, this is exactly the environment where silver becomes more sensitive to macro shifts. And those macro pressures are still present. Global debt remains elevated, currency confidence remains fragile, interest rate expectations continue to shift. Silver doesn't need panic to respond to these forces. It only needs stable demand and constrained supply. Right now, that combination is quietly forming again. Silver also has a habit of moving last. Gold usually gets attention first. Silver follows later, often when most people have already lost interest. That delay isn't weakness, it's structure. Silver waits until physical pressure becomes impossible to ignore. This is why this update matters now. Not because something dramatic happened today, but because the conditions underneath are changing again. New data doesn't shout, it whispers. And in markets, whispers usually come before moves. At the monetary shift, the focus is always on these slow changes that don't trend on social media. Physical markets move on data, not emotions. And right now, that data points toward tightening, not loosening. Going forward, the key things to watch are simple. Inventory direction, not headlines. Industrial demand consistency, not forecasts. Recycling flows, not assumptions. And delivery behavior, not daily price noise. These are the signals that have always mattered most. As we wrap up, I want to hear your thoughts. Do you think physical silver is being underestimated right now, or do you believe supply will loosen again? Share your view in the comments. If this video helped clarify what's actually happening, consider sharing it with someone who follows metals or long-term economic shifts. Thanks for watching, and stay focused.